Hi friends, in this part we shall discuss about the audit of limited companies. Now the rotation of statutory auditors will be applicable to the following class of companies. 1. Listed company. 2. All unlisted public companies having paid up share capital of rupees 10 crore or more. All private limited companies having paid up share capital of rupees 50 crore or more. All companies having paid up share capital below the threshold limit mentioned above, but having public borrowings from financial institutions, banks, or public deposits of rupees 50 crores or more, are required to appoint an individual as statutory auditor only for a term of 5 years, and then there shall be a cooling off period for 5 years. But if a statutory auditor firm is appointed as an auditor, they could be appointed for a 2 consecutive term of 5 years, and there shall be a cooling period of 5 years after that. Rotation of auditors will not be applicable to one-person companies and small companies. Small company means a company other than a public company whose paid up share capital does not exceed 50 lakhs rupees or such higher amount as may be prescribed, and which shall not be more than 5 crores, or the turnover of which as per the last profit and loss account does not exceed rupees 2 crores or such higher amount as may be prescribed, which shall not be more than rupees 20 crores. Provided nothing in this class shall apply to a holding company or subsidiary company, a company registered under Section 8, or a company or body corporate governed by any special act. The class of companies, as I have already explained, an individual auditor cannot be appointed for more than a term of 5 years. An audit firm cannot be appointed more than 2 terms of 5 consecutive years. Then there shall be a cooling off period for 5 years before they could be appointed again. But the companies which are not covered by the above class, they can appoint an auditor continuously after his term of 5 years, and he can be appointed again and again for further periods of 5 years. That is for companies which are not covered by the above class. The Companies Act 2013 makes it mandatory to appoint internal auditor in the following class of companies: every listed company, every unlisted public company having a paid up share capital of rupees 50 crore or more during the preceding financial year, or turnover of rupees 200 crore rupees or more during the preceding financial year, or outstanding loans or borrowings from banks or public financial institutions exceeding 100 crore of rupees or more at any point of time during the preceding financial year, or outstanding deposits of 25 crore rupees or more at any point during the preceding financial year, and every private company having a turnover of 200 crore rupees or more during the preceding financial year, or outstanding loans or borrowings from banks or public financial institutions exceeding 100 crore rupees or more at any point of time during the preceding financial year. The internal auditor could be a chartered accountant or cost accountant, or could be any other professional as the board may deem fit. However, a cost auditor cannot be appointed as an internal auditor during the period he is appointed as a cost auditor in the same company. Now let us discuss the intricacies of audit of accounts in this part. The Institute of Chartered Accountants of India has issued accounting standards. It will be the duty of the Chartered Accountants, members of the Institute of Chartered Accountants of India, to ensure that the accounting standards are implemented in the preparation and presentation of financial statements covered by the statutory audit reports. The Companies Act in India require that the financial statements of a company shall give a true and fair view of its financial statements. The statutory auditor, who is a qualified member of the Institute of Chartered Accountants of India, is entrusted with this responsibility. The auditor should examine whether the financial statements are prepared and presented on accrual basis. The Companies Act also requires preparation and presentation of financial statements on accrual basis. It is the method of recording transactions by which revenue, costs, assets and liabilities are recognized in the accounts in the period in which they occur, rather than when cash is received or paid. The essential features of accrual basis of accounting are: revenues are recognized as they are earned, costs are matched against revenues or against time period in which they are incurred. Costs of raw materials should be matched with the cost of goods sold in the same period. Wages and salaries are accounted in the time period in which they are incurred. The costs whose benefits do not extend beyond the accounting year should be charged as expenses in the same accounting year. On the basis of evaluation of effectiveness of internal controls, the statutory auditor issues his statutory audit report. Now, what is an internal control? Internal control comprises of methods and procedures adopted by the management of an organization to assist in the efficient conduct of business, ensure adherence to management policies, safeguarding the assets, prevention and detection of fraud and errors, and the accuracy and completeness of the accounting records and the timely preparation of financial information. The objectives of internal control system are: the transactions are executed with the management authorization. All transactions are promptly recorded in an appropriate manner to permit the preparation of financial information and to maintain the accountability for the assets. Assets are safeguarded from unauthorized access or use or disposition. Assets are verified at reasonable intervals and appropriate action is taken with regard to discrepancies noticed. Internal auditing is an independent appraisal function established within an organization or by an external auditor. The scope of internal audit is determined by the management. The internal audit report should contain brief objectives and the scope of audit covered, executive summary highlighting significant observations duly supported by evidence, detailed report regarding implications and the recommendations, comments of the internal auditor, and the annexure giving supplementary data. Internal auditor and statutory auditor both have common interest in ensuring that an effective system of internal control exists within an organization and that the accounting system is adequate to generate true and fair view of financial statements. Accordingly, the nature of work by both internal auditor and statutory auditor include the examination of system of internal controls, checking accounting books, records and statements, and verification of assets and liabilities. Both of them examine the same set of accounting documents. It does not mean that the management is absolved from its responsibility in the preparation of financial statements. In limited companies, the board of directors is entrusted with the responsibility and accountability of preparation of financial statements. The statutory auditor gives his statutory audit report based on the internal auditor's report and the management representation. The statutory auditor's report is a collective responsibility. The Institute of Chartered Accountants of India has prescribed the formats of audit reports for unmodified opinion, unqualified or qualified reports on the true and fair view of financial statements dealt with. The statutory auditor takes management representation and the internal audit report together to form his opinion on the issue of statutory audit report. Now in this part, we have given a format of management representation letter that is given to the statutory auditor and the internal auditor report addressed to the board of directors, which shall be useful to you. Thank you.